Hi, Manu. Why are you guys standing up? Okay, I am not comfortable with this. Please sit down and we can talk. Okay, looks like you guys are coming to attack me, right? So I thought since I am, first of all, I am late today, but let me catch my breath, right? Okay, so yeah, okay, why don't you speak? I'll catch my breath and then we'll talk. Okay.
We kind of pissed you off and you walked out of the class. We just thought it was not good in our part to make you feel that way, that you felt the need to walk out of the class.
Okay.
We just wanted to apologize for what we did and we won't repeat that we needed henceforth.
Okay.
Yeah.
Okay, all right. No, yeah, go on, go on.
On behalf of the class.
Right. Okay. Okay. Right. No. Thank you. This of course is not a pleasant thing, for me to do. But I think there is some sense of professionalism that we need to maintain in the class, right? And you might feel that you're sitting there and whispering with your, classmate, laughing at some inside joke or doing other things. But it's very obvious for me standing here, right? And I think it's a disrespect not only to the professor but also to the others who are actually sitting in the class. So that's the reason why, of course, if I had walked out of the class the first time it happened, then I don't think it was fair. But then, since you've had that conversation a lot of times, I thought that I should at least let you know how much I am upset about it. But anyway, that we can leave it behind, right? So I'm not going to carry forward that. And my voice is a little funny because I'm still trying to catch my breath, right? But hopefully that will kind of settle down in the next few minutes. But anyway, before we start, sorry that I'm a little late today. I got a little late leaving home, and that's why I ended up coming a little late. But uh, but okay. Anyway, we'll forget about that, and then let's come to the content. Okay. Any questions? But yeah, I appreciate that. Right. So I appreciate that the apology. But an apology is meaningless if the behavior continues. Right. So I understand that Zayan, right? So Zayan mentioned that you're not going to continue with that behavior. So let's stick to that, right? And I also want to talk about something else, but I will talk about that a little later, right? So once I catch my breath. All right. Any questions before we proceed? What we discussed yesterday? I need one more, the other PPT. Just give me 1 minute. Sorry, just give me a minute. Okay, so we had discussed the indirect cash flow statement, and then we are done up to here. Is that right? Okay, so we looked at startups that are at the introduction stage, and the startups that are at the growth phase. And we said that depending on the life cycle, the stage of the life cycle in which the company is, your CFO and CFI and CFF will keep on changing, right? So what we're doing here is that we are trying to relate what happens in the real world to how it gets reflected on the financial statements. So once the startup goes in the introduction stage and once it grows, typically, there are other stages also in between that we can have, right? So, for example, if you're talking about a startup that does not die, so you introduce and then the startup kind of establishes itself, and then it enters into the growth phase. And typically there is a phase that we talk about here which is called as the shakeout phase, right? After the growth period. So in the shakeout phase, that's what determines whether the startup will go on to the next phase, which is the mature phase, or if the startup kind of dies in that particular phase. Because introduction and growth is something that most of the startups do, right? There are some startups that might die at the idea stage itself, but once you have like the early stages and then you put in some capital, and the investors also think that we have to give some time to the startup to kind of grow, so the startup grows. But at the shakeout phase is where you kind of figure out that whether the startup is actually going to die or the startup will go on to growing further and then actually becoming a mature company, right? But we leave out the stage shakeout stage here because it's very difficult to kind of tell. Different startups will behave in different ways. So analysis like this for those kind of startups which are in the shakeout phase actually doesn't help us. But what we will do is we'll assume that the startup has been able to be successful and it's actually grown and now it has actually become a mature company. Are you with me on this point? Okay. So now when it becomes a mature company, how will these three items look for it? The CFO, CFI, and CFF. Let's look at CFO first. A mature company, it should be positive. Why should it be positive?
Because when company so cash flow should be revolving, they should be having profit.
Yeah, exactly, right. So you will say that, look, if the company is mature, then you would expect that the company actually is going to be profitable, and the company will actually be able to generate more cash than what is the cash outflow that is going to happen. We would expect CFO to be positive. Okay. What about CFI?
It should be, it can be anything.
Huh? Sorry.
It can be anything.
Correct. It can be anything, but what would be your best guess?
Negative.
Why negative?
Positive.
They would be investing more because now they have money.
For the growth.
Okay, once again, okay. People who think that CFI is going to be negative, give me your justification. I'll come to positive in a minute. Yes.
Because you invest more into your machinery, assets, etc.
Huh.
For the growth of the company.
Okay. Anybody else who wants to argue for negative? Any other reason? Okay. Yeah.
And also, as they are now they are in a mature state, they will be also investing or giving out loans or anything to other people as well.
Okay. But then we said that we will look at only the operational investing activity, right? So if you're giving out loans, then that doesn't make an operational investing activity unless you're a bank. So we'll assume that we are talking only about the operational investing part and not the other, like the extra money that you have, which you might give loan as another company or to sister company or something like that.
It will be negative because you have already invested in machinery.
Hmm.
If you still invest, it will go negative only.
Correct. Okay. Right. So essentially, you're saying that investment is the argument that you are having for negative. Anybody else who wants to argue some other point for negative? Yeah.
Something similar, but your company might be in a profitable state, but your investments are not proportional to your state of the company.
Okay.
So if the company is profitable, that doesn't mean investments are profitable.
Shoots. Okay. No. But then when you're talking about investing cash flows, you're only talking about the purchase and sale of fixed assets, right?
Okay. Yeah.
So because you're not talking about like FD that you're making or loans that you're giving to your sister concerns or subsidiaries or other things. You're only talking about what is the simple way is what you're looking at. What is the kind of purchase and sale of fixed assets that you're doing
So can
broadly?
you say that the stage of the company is equal to, like, proportional to the returns or the state of you getting returns? You cannot say that.
Yeah, no, you can't say that, but on average, you can, probably say that. See, typically what happens is that if you look at profitability, typically you start off making losses, and then you kind of gradually reduce the losses as a percentage of your sales. So one of the really stupid things that I, get to see in the financial press is where, okay, so let's say that you read this in the financial press. Okay, so I'm taking a small, detour because this is one of my pet peeves. And I get really pissed when I read this in the newspapers. So where they say that, the revenue of the company, increased by some company. Take Zepto for example. The revenue of the company increased by 80%, but the losses also went up by 40%. Okay, they sell this as a negative news, or they don't even talk about percentages. They will say that the company's revenue went up by so many crores to so many crores, but the losses also ballooned from so many crores to so many crores, right? So, what is it that is wrong with this kind of framing, where they say that this is something that is negative? Yeah. Oh, okay. Okay, I need somebody to take responsibility for this, right? So before the class starts, of course, we have only 3 more sessions, but before the class starts, can you do that? Right, before the class starts, just make sure that the board is, set up properly. Okay, if you're not there, then somebody has to kind of do, whoever is assisting him, just make sure that you take care. Because Kashi already have too many things to do, so you can help him out a little bit. Yes, yeah, one of you.
Yeah, so I think that gives a false sense of portraying the company, because then
Why?
the investors or just people who want to invest in a publicly listed company cannot make an informed decision.
No, that's correct. But then what is the problem with this framing?
The losses increasing while revenue also increasing is not a negative thing, but that's how it's portrayed.
Yeah, but why is it not a negative thing?
Because losses just mean that the return is not immediate. That's how I look at it. Like if Zomato, when it was scaling up Blinkit,
Hmm.
it was in losses.
Hmm.
That doesn't mean that it's a negative thing or I should not bet on Zomato
No, but why? You're not answering the question. Why?
because the return is you will get it at a later stage, not now.
Okay. So what you're trying to say here is that you're trying to say that look, there are certain investments that I'm making right now which are not going to pay off right now, but they're going to pay off over a long period of time. But let's say I give you a counter argument saying that if these are long-term investments, anyway they are going to be like fixed assets, and therefore they are actually going to be depreciated over a period of time, and not everything is going to be taken as an expense in the first year itself. If you say that that explanation is valid, then how would you respond to this? Would you say that this is the company doing well? Is the company doing better as compared to last year, or is the company doing worse in this year?
I don't think it's enough information to say that.
Okay, all right. Let's see. Yeah. Sorry, 1 minute. Let me just go with others because most likely give me the right answer. But then let me just check if the others can actually. Yeah.
So basically, when a company is expanding, it burns money.
Huh.
So it invests more and more.
No, correct. But then that's the point that Surya was
After it
making, no?
invests, like at a point of time, it'll start having profit.
No, correct, correct. See, but my point is that let's say that you make a lot of investments. If those investments goes off as fixed assets, what I'm trying to say is, let's say that if you buy a fixed asset for 1,000, okay, and then you do marketing expenditure for 1,000. Now the difference between these two is that when you spend 1,000 rupees, so totally I've spent 2,000 rupees. When you spend 1,000 rupees on fixed assets, and if this fixed asset has a useful life of 5 years, then every year you get an expense of only 200. So what you're trying to say there is that, look, I know that the fixed assets benefit are going to come to me over 5 years, but the expense also is being recorded over the next 5 years. So we have to differentiate such expenses from, say, marketing expenses, where any promotion or any marketing expense that you do, the entire thing is going to go as 1,000 expense in the first year itself, unlike the depreciation part, right? So if you are talking about expenses like marketing, where you will say that, look, this is long-term brand building, but then, due to accounting rules, we have to make sure that everything is expensed off right now. I buy that argument where you're trying to say that, look, the brand that is being built, you're going to spend now, but the benefit is actually going to come over 3 years. But whereas in accounting, we record everything as an expense in the first year itself. Why does accounting ask you to do this?
It is better to have the worst case scenario.
Right. Again, which is the principle you're talking about? It is kind of prudence and conservatism, but also what you have to understand is that you are not sure if the benefits of this marketing expense will actually be realized. So you have like a the realization principle also that is there. So what you can say is that, look, if I buy this furniture, then I have more guarantee that this furniture is actually going to be useful for me for the next 5 years. But then when I actually have marketing spend, there is a lot of uncertainty in terms of whether the benefit is actually going to come to the company or not. In fact, there is a inside joke with marketing people. What they say is, I know that 50% of my marketing spend is beneficial, but I don't know which 50% is beneficial. Right? So you can't identify, if you do 10 campaigns, you don't know, you know that there is going to be some benefit, but you can't identify which are the 5 campaigns that actually are beneficial and which are the 5 campaigns that are actually not beneficial. So then, what is the most rational thing to do? Is it that you say that I will not do any marketing campaigns at all, or do you do 10 campaigns and then hope that some of them will work out? You'll obviously do that, right? Because you can't say that you are going to keep idle, because if you're keeping idle, then it means that nothing is going to happen. But if you at least do 10, there is a possibility that you might actually see some returns from that. But accounting says, look, that might work for strategy of the company or how you actually going to run the company. But then that doesn't work for accounting, where we are not sure if the benefits are actually going to be realized. And being prudent and conservatism, we say that it's better to expense off that right away. Okay. My point is, let's assume that there are no such expenses, where you would say that there are benefits that are going to come later. Let's assume that we live in a world where there is perfect matching between the benefits that is there, that the expense is going to get, and the expense being recorded. That is, we have only this kind of things. In such a world, and if you see this in the newspaper and it says that it's a negative sign, how would you respond? That's the question. Are you with me? Okay, what I'm asking? Yes, somebody else? Anybody? Somebody had their hand up that side? Okay, yeah.
So if it does have operational loss, it will impact worse. But if it's not, then
Okay, let's assume again this is operational loss. So that's fine. I will give it to you. I will call it as operational loss. So is the company doing better than last year or worse than last year? But losses increased, no? The loss has, of revenue has gone up 80%, loss has gone up by 40%. Losses also increased. Yeah. Yeah, yeah.
The revenue has increased 80%. That means in the previous year, if the revenue was 100,
Huh.
this year the revenue is 180. And if the loss was 10 last year, the loss has increased to 40. That means there had been a greater proportion of increase of revenue as compared to loss.
Right.
So the company financial has improved.
Okay, so what is a easier way to understand this, or what is a better way to present the same argument where you're talking about comparing revenue and losses of this year to the revenue and losses of the last year? You're on the right track, but I want you to give me one metric that will make it very clear. What is that metric called? You actually referred to that, but you didn't give me the name. So I'm asking you for the name. Profit and loss is anyway there. Okay, sorry, this is minus 14 and minus 10, right? Because it is losses, so I will take it as minus. Is there any ratio that we can use to make this crystal clear? Yeah, not revenue to loss, but profitability, right? So what we call as profit margin. So what you do is you represent this as a profit margin. Of course, here it's going to be a loss margin, but your profit margin essentially is whatever is your profit divided by your revenue. Your profit is minus 10 because, if I say profit is minus 10, that's the same thing as saying that the loss is going to be 10. So if you look at the profit margin here, now if you calculate this, so if I say that the profit margin or the loss margin of the company was minus 10%, last year, but this year, what is the loss margin? Calculate this, huh?
7.7.
Okay, so it is roughly around 7.7%. So do you think the company has done better? Why has the company done better? Because, as he rightly pointed out, your revenues have increased by a larger proportion as compared to your losses. So this framing actually is wrong. So the correct way to frame that would be that you will say that, look, last year the company had a profit margin of minus 10% or a loss margin of 10%. This year, the company has improved where it is able to increase its sales, but then the losses as a proportion of sales actually has reduced. So you will say that the company has done better this year as compared to the next year. The reverse also happens, where sometimes they will say that the revenue increased by 40%, and then they will say profit increased by, revenue increased by 80%, and profit increased by 40%, and then they say it is good news. Okay, so then it does not make sense, right? Because if you just change the numbers here, what you will see is that the margin in that case was plus 10% last year, but even though the company has made more profits this year, it actually as a percentage of the revenue, it's actually come down, where it had made a 10% profit last year, but whereas it has actually made a 7.7% profit in this year. So it is important to look at the profit margin and not just look at the quantum of losses or the quantum of profit that the company has made. Are you with me? Okay, right.
One thing that I would like to add over here to this point. Sometimes it's even important with these statements to go through the financials very well. Like during the buzz of the March quarter or the June quarter, when Eternal released its reports, their profits had come down subsequently by 50 to 80%, and the revenue had increased by 200%.
Okay.
But if we see the reason of such high differences was the rapid Blinkit expansion.
What do we call that as, the analysis that you're talking about? What is the name that we give to it? Huh? That is true for everything, anything that you say in the class, right? Okay. Right. So that is called as earnings quality analysis, right? So where you just don't go by just the numbers that you see, but then see that, read more of the financials or analyze the financials more is a standard answer that is applicable for any observation that you have, right? So anything that you see that the revenue has increased or the profits have decreased or the company has more investments, whatever be the statement that you're making, the answer to all the statements that you have in accounting or finances, go and read the financials, right? So that's a standard thing that you need to do. And of course, when we do earnings quality analysis, we kind of figure out as to what is the source of the profits or what is the source of the losses that the company is getting. And when we actually went through the Lenskart numbers, we are actually doing an earnings quality analysis where you're trying to say that, look, the company might look, the bottom line might actually be profitable, but you can see where the profits are actually coming from. And then we saw that one of them was just an accounting jugglery kind of a thing, and the other was some non-operating assets which they had sold, and it was other income that actually increased the profits of the company, right? So that's the earnings quality analysis that we speak about. If you're hearing earnings quality for the first time, in the class. What does it mean? No, in the quiz there was an earnings quality question, right? But then I actually hate professors who ask questions which are not covered in the course. Am I one of them? Sometimes, okay, right? I will address that separately. But what is the reason I gave you the earnings quality analysis question in the exam?
It was very generic to.
No.
No, I felt the question was very easy to understand and anyone could have got the.
No, that is there, but I'm saying that's not the case, right? Because that way I can ask any question in the exam, right? What does it mean that if you have heard about earnings quality phrase for the first time in the quiz, what does it mean?
We had done that in Lenskart.
Yes, but have you covered it elsewhere?
No.
Think about it. Oh man, I thought at least one person will say this.
There was a entry in one balance sheet where it had written EP disposal, and then you had,
Where was that?
it was in like other incomes of
Correct, but no. What was the source there? Where did I discuss that? No, I mean,
SPL.
in which? Okay, in SPL. But did I discuss that in the class? Where did I discuss that? In the video that I had sent you, right? So I'm trying to kind of politely point out that you guys haven't seen the video. Okay, and so now if you come and tell me that I have great fun, when the student comes and tells me that's how you didn't cover this in the class at all, then I have great fun in actually pointing out where exactly I had covered that in the class, right? Because I maintain a log of what has been covered and where something has been covered, right? Of course, we agreed that there's not going to be any videos, but then also I told you that given that we were lagging behind a little bit, I'd asked you to please see that video, right? Because I have covered a lot of important points that are there. And to answer his question about me asking questions which have not been covered in the class, so those will be the application level questions. Of course, he's not the only one who feels that way, right? So all my students feel that way. In fact, I would be insulted if the students don't feel that way about my exams, right? So those are actually application level questions where that will be, of course, maybe 20% of the question paper where I would expect you to kind of put two things together. So I would have spoken something about in the 7th session, and I would have spoken something about in the 11th session. So only when you're able to connect those two is when you will be able to answer such kind of questions. Okay, so like I had sent the academic team, Mansa and Ajit, a breakup of what are the different kind of questions that are there. Was that shared with you? Okay, I will just check with them. I don't know if I don't know if I told them to share with you. So essentially, if you look at quiz 1, I didn't share it for quiz 2, but if you look at quiz 1, I think close to 60% of the questions was what I had directly discussed in the class, right? So if you had paid attention in the class, then if you had studied your notes properly, then 60% of you could have scored 60%, and then the remaining like 10 or 15 was from textbook material which had asked you to study, but I had not explicitly covered that in the class. And the remaining 10-20% was application level questions where you had to apply what you had learned in the class, right? Because typically there is a breakdown. This is a broad breakdown that I typically follow. 50-60% what is covered in the class, and a little bit which is not covered in the class but is there in the textbook. So essentially, I am trying to make sure that people who have studied, paying attention in the class, are able to score the bulk of majority. And if you have studied the textbooks properly, then you get to score a little bit more. And if you're able to kind of connect things, then you're able to score a little bit more, right? So please look at my question papers in this particular format, right? And this is a constant any year where the student says that I found I was happy with the exam, then I know that I'm losing my touch. Right, so you should, by definition, students should be unhappy at the end of the exam, and after I give them the answers, they should think, why didn't I think of it, right? So that's, of course, that's the way to learn. I mean, that's the way my professors made me learn, and that's why I'm just continuing that legacy of making sure that you're able to kind of relate to the exam. Because I mean, it's no point if I just give you simple questions in the exam which I've already covered in the class, right? Which is there, the lion's share is that, but then I also expect you to kind of make connections with things, because that's the only way we're able to learn, right? Yes.
I had a question with earning quality analysis.
Okay. Yeah, sure. I would see. You can always ask a question, but I will decide when to answer.
So basically, if a company is operating profitably,
Uh-huh.
like the cash flow, like operating activities, they are profitable.
Hmm.
Investing, they are loss making. But when it comes to
No, one second. But how will you make losses in investments?
like non-operating rather than investments, I should be saying non-operating.
Give me an example of where a company will make losses in non-operating losses.
Charlie.com.
No, but then that's the name of a company. Yeah? I'm asking you, you know.
Marketing.
But marketing is not a loss, no? So marketing again is an operational.
There are a lot of expenses. Expenses are more than revenue.
But then you will consider all of that under operating only, no? It will not come under investing.
I'm telling you GP level. That's why I said
Okay,
non-operating.
okay. Let's take this offline because you know I think we need a more detailed discussion, but we can have a chat offline on this, right? Okay. Any other questions? Yeah.
I have a request.
Huh.
In the question paper, I saw there are a lot of short forms.
Okay.
I have confused because DLF, I don't know what the full form of
It's a
DLF.
company.
But the DLF, I thought.
It's a company.
No, but huh? No, that's the reason I expanded HUL because HUL was yeah. The answer was DLF.
I need to choose the manufacturing form and I don't know what's the full form of DLF. So
No, DLF. There is no full form. That's the thing. The name of the company itself is DLF. See, actually, the full form of DLF is Delhi Land and Finance, which I got to know 2 days back. So that's what. See, because you know, when I was actually, I'll tell you my thought process, right? So when I gave the names of the company, you know, in fact, the name of the company of DMart is not DMart. Okay. Do you know what is the name of the company that runs DMart? Avenue Supermarkets, right? Or Avenue Supermarts. I don't know the exact name of the company. But I did not give Avenue Supermarts because I thought that you guys will be more familiar with DMart, which is actually the brand name of the company. That's the reason I gave DMart. Then HUL I expanded because your generation, I don't expect you to kind of know HUL, but that's the reason I gave it as Hindustan Unilever Limited. But the problem is DLF, there is no expansion. If you go and look at the formal name of the company, it's actually DLF. So it is not a short form. DLF is actually the name of a company. But I understand your point, right? But I thought DLF was common enough that you guys haven't heard of DLF before. Okay, I mean, yeah, no, some of you would have heard, right? So, okay, tell me something. How many of you had not heard about DLF at all? Okay. Huh? How many of you had not heard about DLF? Okay, so how many of you did not know that DLF was a real estate company? Okay, similar numbers. You might have heard, right? So roughly that is the case, right? Okay, so let me think about this because I thought that you know DLF was something that. Okay, how many of you have not heard about Infosys? Okay, honest to God, I thought the DLF recollection is going to be the same as the Infosys recollection that is there. This is actually quite surprising that. That's fine. I'm not saying that it is wrong that that you had to know about DLF because you know I'm more interested in finding and testing your conceptual understanding rather than your you know general knowledge here, right? But that's the reason that is there. So my response to that would be that look, maybe I should have framed the question as a real estate company and a supermarket company, but then I thought that will become a little you know too easy. Right, because once I describe the company, then it becomes a little easy. So I introduce one more layer of thinking, where I wanted you to kind of know the company, then look at what is the kind of you know business that it does, and then come to the answer as to which is the company that will have the highest operating cycle. Okay, right. So let's do this now. The advantage is till you die, you will not forget about DLF. You know why? Because that losing that you know half a mark or 1.5 mark actually hurts there, right? So because I've given you the learning, I'm going to keep the question there because I was thinking that I will actually make a change, but I take the feedback, right? I'll be a little bit more you know careful when I set the question paper. And see, unfortunately, I can't show you the question before the exam and say, "Do you understand the question?" Right? So that is not possible. But I will keep this in mind. So you know, typically, I face this issue when, say, at IMB when I'm teaching. There are some terms where you have exchange students who come, right? So if I tell you eternal, then you understand that, right? But then somebody who's coming from Europe will not understand that what eternal is. So I kind of try to make sure that India-specific content is actually not there in the you know exam. But then in this case, you know, somehow I think the assumption that DLF will actually be known to everybody was wrong, right? But I will try to make sure that I don't, you know, this error does not repeat. Okay, yeah.
so the second correct option will be Asian Paints, right? Because it's a manufacturing.
What were the options I gave? I forgot. DMart was one. HUL, yeah, correct. The second option would be Asian Paints. For what? No, but now the problem is. No, but the problem now is that you know I see when you say that you don't know DLF. No, that's what I'm saying. No, so when you say that you don't know, when you say that you claim, or if a student claims that they don't know DLF, I don't have a lie detector, right, to figure out as to whether they actually did not know DLF or not. Okay, how about this? I will do this. Okay, so as a compromise, I will cancel negative marking for that question. Okay, so that seems fair, isn't it? So where given that they had a problem here. See, how does it matter to you, right? If you have got the answer correct, okay, then let's do one thing. Shubham, sorry, Shubh, sorry, yeah, go on.
So another question in which there were multiple methods, laptop for depreciation
Uh-huh.
in class.
Okay, 1 minute. Oh, right. No discussion of any more question, right? After this, because I've already asked him to ask the question. That's the reason I'll, ask him to answer this. This is the reason why I don't discuss exam questions in the class, right? Because each of you will have one, question that your pet question that you want to ask. So that's why we'll do it, outside. Actually, let's do one thing. Talk to me in the break. Okay. So I will talk to you in the. No, it's okay. See, when I say that, you have to stop talking, right? So that's the thing. All right. So no, I was about to say that, Shubh, you guys discuss and tell me what needs to be done. But then the majority is going to win, right? So let me do this, right? So cancel. I forget that I actually asked you. Sometimes I wish I had this. Have you guys seen Men in Black? I wish I had that device, right? So where I flash it and then you forget what happened in the last 5 minutes. But anyway, since we live in the real world, I have to kind of manage with this. So this is what I'm going to do for the DLF question. I will tell the team not to give negative marking, so that if you have chosen DLF either because you knew it or because by chance, you will get 1 mark. If you have chosen something else, then you will at least not lose that half a mark, which is negative marking. I think that's a fair, given the circumstances, I think that's a fair arrangement. Okay. If you're not happy with it, talk to me outside the class, right? I'm not asking you to keep quiet, but talk to me outside the class as to why you're not okay with that. Okay, let's come back to this. Okay, where were we? I don't know. There was too much of a detour, right? So let's actually come back to this and then talk about the mature company. So for a mature company, we were thinking about, or we were talking about why the CFI should actually be negative. So we heard the negative arguments. Anybody else who wants to argue for CFI being positive? Yeah.
It's already mature.
Huh.
It's not growing. It's not in the growth stage, so it
Hmm.
doesn't need a lot of investing activities. So
Okay.
It should ideally now be, it should ideally now be a stable company. For that, they don't need a lot of investment, so it should ideally be a positive CFI.
See, now what does it mean when you say a positive CFI? What does it mean? Think about it.
Okay, rather than positive CFI,
Huh.
it should be like a no. It should be a zero kind of figure. I would like to make it, or
Oh.
it should be tending towards the positive side, like lesser negative, but it should not be as negative as it was.
Okay, fine. Okay, fair enough. So, for example, if you look at it as a percentage of sales of the company's sales, you would expect that to be a low percentage, right? So, a low negative. Okay, yes.
In terms of a mature company, right?
Huh.
You made investments. Now you sell those investments and make new ones. So net, because you made those investments before, the then will be positive, because just adding on to what you say,
Hmm.
you will like it's the sale of fixed assets,
Right.
Basically.
Right.
So you'll have fixed assets that you already had, like in the growth stage, and then
No, fair enough. I'm sorry interrupting you, but then, in the interest of time, right? So I understand that, but think about this. No, so let's say that a car costs 10 lakhs, and let's assume that the value of the car does not change at all over 5 years. Or what I mean is the price of the car does not change. So when you are actually selling a car that is 5 years old, how much do you think you'll be able to realize? You will realize not a bit less. After you have actually used it for 5 years, and given that it's a commercial usage, you will probably get 5% of the car value, right? So you will actually end up getting only 50,000 for the car that you're selling. But for the new car that you're buying, how much you should spend? You should spend 10 lakhs, right? So I agree with your point that the sale of fixed assets will reduce my investments a little bit, but then the positive and negative number, the negative number is going to be much bigger as compared to the positive number. So that's the reason you might not find CFI to be, positive.
In that case,
So-
CFA can never be positive.
Yeah, so CFI becomes positive. We will see as to when CFI is going to be positive. Okay, so let's assume for now that CFI, or let's consider for now that CFI is going to be slightly negative, and then let's go to the next one. What about CFF? Cash flow from financing. Not in growth. No, you're asking a question. No, I mean, you're asking a question, or you're telling me the answer. Which one? CFF. Oh, CFF for a mature company. Yeah.
that would be negative,
Why?
because
like the shares, equity holders would want a share. So we will be giving out loans, and if it is
What will you give to shareholders?
if there are loans, we will give out loans like debentures. So that would be like,
No, if you're issuing debentures, then the CFF is going to be positive. No, you're not raising additional capital. Then it becomes positive, right? But what makes it negative?
Since the company is already grown a bit, so they won't need more investment, so they won't need dividends. They will usually just give out dividends to the shareholders. So it would probably be negative.
Yeah, right. Okay, so that's a reasonable argument, isn't it? You will say that you're actually, you will give dividends to the shareholders, and then you will start repaying your loans, and then you will pay interest on the loans, etc. So it is likely that since you're not raising any additional capital, because you know you don't need too much of investments, it is likely that the I'll take a question in a minute. It's likely that the CFF actually is going to be negative, right? So when you have mature companies, oh, I should have displayed this. When you have mature companies that are doing well, so your CFO is going to be positive. I'll come to CFI in a minute. And your CFF is going to be negative. Why? Because you're actually net, you'll end up actually repaying the loan and not raising two loans. So, and not raising new loans. So you'll pay dividends, you'll pay interest, and then you're repaying your loan. So you'd expect CFF to be actually negative. But your CFI is actually going to be positive, but then the CFI is actually going to be negative, but then it is actually going to be a low negative. So this is where we need to understand something that is called as so when you have your capex, that is capital expenditure, that is the amount of money that you're investing in fixed assets, we need to differentiate between what is called as a growth capex and what is called as a maintenance capex. So when I talk about maintenance capex here, I'm actually not talking about repairs and maintenance that is done, right? So not maintenance in that sense. Let me give an example to kind of understand this, or let me describe this first, right? So when I talk about maintenance capex, I am talking about capex that needs to be spent in order to maintain your level of capacity that you had earlier. When I talk about growth capex, I am talking about the capex that needs to be spent in order to increase your capacity as compared to what was there in the previous years, right? So how do we understand this? So let's assume that a company has 10 machines, right, and each machine can actually produce 1,000 units. So the capacity of the company right now is 10,000 units, right? So this was the situation in the last year. Now what happens is that one of the machines the company has to retire. Why? Because the machine actually reached the end of its useful life. So therefore, one of the machines the company has to retire, and the company wants to increase the capacity to 12,000 units. Okay. So if this is the case, how many machines should the company buy in this year? Let me repeat the question. The company has 10 machines. Each machine can operate 1,000, can generate 1,000 units, can manufacture 1,000 units. So the total number of units the company can produce is 10,000 units in a year. One of the machines has reached the end of its useful life, so that machine has to be retired. But the company wants to have 12,000 capacity in the coming year. Okay. How many machines should the company buy? Three machines, right? So that is easy, right? Because you know that if the 10 machines are there, one of them will go off, so it will become 9 machines. And if you want 12 machines, then you actually have to buy 3 machines. Now, what you have to understand here is, between the 3 machines, both of them, I mean, all 3 of them are going to be equal. But when we analyze it, we will say that the growth capex is 2 machines, but whereas the maintenance capex is 1 machine. Why? Because when you're actually buying that one machine, you're trying to reinstate the capacity back to 10,000, because without 10 machines, your capacity has gone down to 9,000. So first is you're trying to maintain the capacity of 10,000. So therefore you buy one machine. But additionally, what do you want to do? You want to grow. So therefore you want to increase your capacity. So the 2 machines that you are buying, we'll call that as growth capex. So maintenance capex is whatever is the capex that you're doing in order to maintain what was your capacity previously. Growth capex means whatever is the capex that you're doing in order to grow your capacity. Does this make sense? Okay. So with startup companies or with younger companies, companies that are there in the introduction stage and the growth stage, there is a lot of growth capex that happens. Okay. Why do young companies don't have too much of maintenance capex? Because one, of course, all these are new machines, right? You're not going to replace your machines just after 1 or 2 years or 3 years. So in the younger stages, what happens is that the growth capex is something that is substantial. Your maintenance capex is going to be low. But once you become mature, since you don't have many opportunities to make investments, the investments that you will do, buying of fixed assets, etc., will predominantly be only the maintenance capex and not your growth capex. So when you look at a mature company, whatever is the investments that the mature company is making, buying of fixed assets, long-term assets, will predominantly be your maintenance capex. I mean, there might be a little bit of growth, but then most of the money that the company is going to spend will be your maintenance capex and not your growth capex. So that's the reason you will see that for mature companies, your cash flow from investing has to be slightly negative. So when we talk about all this slightly negative, etc., right? So what you have to understand is you always have to scale that by some number. So typically the scaling number that we use is your sales number. So what we do is we say that, say for example, let's say that this I give you this data, right? So there is a startup, okay, let me not call it as a startup, let me call that as a young company, and then you have a mature company. So then I tell you that the sales of the young company is 100, but whereas the capex that the young company is doing is 20. Okay, as opposed to the mature company has a sale of 10,000 and the capex that the mature company is doing is 200. Okay, where would you say that there is more capex that is happening? Why? But 200 is more than 20, isn't it? You look at percentage, you will say that, look, given for a small company, the capex percentage is 20% of sales. But then for this mature company, the capex percentage is only 2%. So it is wrong to compare 20 and 200, but it is, you have to actually compare, you have to scale it by something. You can either use sales, or you can use total assets, or you can use total fixed assets in order to make sure that you're looking at the right comparison, right? So where you do an apples to apples comparison and not an apples to oranges comparison. Are you with me? Okay. Yeah, you can do it with assets, right? So you can do it with assets, you can do it with sales, anything is acceptable. See, because all of them are related, right? So we'll kind of talk about this in the financial statement analysis, which we'll do after the break. We'll start after the break. But you can do it with assets as well. But there's nothing wrong with doing with sales, and nothing wrong with doing with any other number which you think is relevant. But yeah, so the top two choices are sales or assets, and as long as you're using one of them, it is fine. Okay. All right. Let's move on then. Now we come to the fourth one, that is declining company. So you have a mature company, a company that was mature and it is declined now. How would you expect the three numbers to come? I mean, to appear. CFO is going to be negative. Why? Right. So essentially, it's likely that they are undergoing losses because it's a declining company, which is profitable. Then obviously the company is not going to decline. Right? Yeah. CFI. Why?
Because company is declining and there will be a lot of sale.
Right. Okay. Thank you for the reminder. Whoever gave the alarm. But yeah, so essentially they'll be selling off the machine because they are declining. So therefore, I mean, that's a very passive aggressive way of saying that, boss, it is time for the break. And why the hell are you speaking, right? But anyway, I'll close the class in a minute. Okay, now so the problem is that when my brain power is used to crack the silly jokes, I forget about finance. Okay, now I have to come back to finance. Okay, so CFI is going to be positive because the company actually will actually be selling the assets. What about CFF?
So it would be positive.
Why?
Because they are not doing well, so they would be trying to raise more and more funds. So that's why it would be positive.
If let's say that Vijay Mallya comes and asks you for new funds, how will you respond? Who will be interested in investing in a declining company? So CFF also.
They would be taking some bank loan and also
depends on the case.
No, that is true. But the problem is, think about this. No, who will give money to a declining company? Sorry. Yeah, so people will actually be asking, I know that I've already given you a loan. Now, if I give further loan, then I'm not going to get back my money. You first repay the loan, then I will think about giving you. That's an important question to ask, right? So that's the, what Shubha is actually pointing out is correct. Because if you're generally starting to decline, then you might be able to convince banks to lend you at a higher rate of interest. But if you're already declined and if you're unable to kind of show that there can be a turnaround, then typically you will see that it's actually going to be a negative number, right? So of course, here we are assuming that this is something that the decline is irreversible. So our CFO is going to be negative, And since you have to repay all these loans, you will start selling your fixed assets. So that's the reason your CFI is going to be positive, and your CFF is typically tends to be negative. But remember that these are only broad. It's just a broad framework to kind of connect. So my primary interest in actually doing this slide is so that you can connect what is the kind of transactions that happen in the real world and how they get reflected on the financial statements. But as Shubh is rightly pointing out, it is quite possible that you can see that your CFF also can be positive, where you are trying to sell a story to the lender or to the equity holders that, look, I know that I'm declining, but then if there is an infusion of new capital, then there is a possibility of a turnaround, right? That's something that we need to keep in mind. Is that fine? Okay, all right, yeah.
So, but the type of decline would impact the
Absolutely.
state, right?
That's exactly the point I was trying to tell him, no?
Acquiring versus losses and declining.
Oh, like that? No, no. So when I say declining company, say I'm not talking about disappearing company. I'm talking about declining company.
Didn't you yesterday mention that declining?
No, no, death. There's a difference between decline, death, and disappearance, right? So think about that. We can discuss that in the break. But then when you're talking about declining company, this is a company that is still continuing. I mean, when you talk about declining company, just think Anil Ambani, right? So you, huh? So no, but the sun is rising, yeah. It's not the the dad's company, right? So you're talking about such kind of thing. Yeah, of course. I mean, it's being uncharitable, because to businessmen when we actually talk like that. But I'm just telling you that when you're talking about declining companies, these are companies that continue to exist, but then they are unable to turn themselves around. Okay, okay. Just one quick thing. So last slide, which will take exactly 60 seconds, right? Because I want to do this because this is from the investor's point of view. And what we're trying to do here is that, so again, there's like a 2x2 matrix here. So here, typically, think of this like a VC who is invested in a startup, and then, there are four possibilities that are there. That is, you have your, operating profit after taxes, that is EBIT into 1 minus T. So the NOPAT is either positive or negative. So when I say positive and negative, I don't mean slightly positive or slightly negative. I mean that is substantially positive or substantially negative. And similarly, you have your cash flow from operations. Either they're substantially positive or substantially negative. So it gives us four scenarios. Let's go one by one. So if you're an investor and if your company, the company in which you've invested, has your CFO positive as well as NOPAT positive, will you be happy or sad? You'll obviously be happy, right? So because you know that the company is doing well, both in terms of profitability as well as the operations cash flow that it's generating. If your CFO is negative, but if the company is profitable, will you be happy or sad?
Concerned.
Okay, so maybe you'll say that there is something in between that I'm obviously I'm not happy, but then I am actually going to be a bit concerned, because then the question will be that, look, the company is profitable, but why is the company not able to generate this cash? That's the question that I'll be asking, and I'll try to figure out as to, is there a way I can kind of understand why the company is unable to generate the cash while being profitable. What about the third part?
What if the operating expenses are more?
Huh.
What if it's negative, but there's also profit? Then
Meaning?
I wouldn't be. So operating, you're saying cash flow from operating activities.
Mm.
You're saying if that is negative
Mm.
and NOPAT is positive,
Mm.
then you would be concerned. But
Mm.
what if the operating expenses of the company are so much in the temporary stage, just that, but still they're profitable? Maybe I'd be happy that in the coming days the operating expenses will decrease.
Okay.
And the NOPAT will stay.
No, but then see, the point there is that there's an internal inconsistency there in that question, right? Because if your operating expenses are more, then your NOPAT also will become negative. Right? If your operating expenses are more and still if your profitability is high, or if you have a positive profit, it means that you're able to generate much more revenue to cover that operating expenses. But I see where you're going. We'll discuss that at the end of this slide. Third one, again, I'm going to be concerned, right? So because I know that while CFO being positive is something that I mean, you can use some other word here, but then I've just used concerned here. CFO is positive, but then the company is actually not profitable, and therefore I am actually going to be concerned in this stage as well. What about fourth? I'm going to be upset, right? Or I'm going to be sad here, because I will say that, look, everything is negative, so therefore there's nothing to actually look forward here. But the key question here is, will the concern be greater in 2 or 3? That's the point that he was making. Okay, so I wanted to think about this because I've already overshot the time. So we will come back, and then I think that was the last point, right? So I want you to think about this. So I'll take questions later. So I want you to think about between 2 and 3. in which bucket will the investor be more concerned, and what is the reason for that? Okay, let's meet in 10 minutes. We'll come back in 10 minutes and then I'll take questions. Can you wake them up, please? Okay. Between 2 and 3, we said that where will the concern be more as an investor? Okay. Who wants to argue for 3? That 3 essentially is where the NOPAT is negative and the CFO is actually positive. Yeah.
Sir, I would like to even change the word from concern to skeptical.
Okay.
Because I believe even it's when your NOPAT is negative
Huh.
and your CFO is positive, there's only one case of this happening.
Huh.
That is you receiving back from the trade institutions.
Okay.
The trade institutions you are receiving, and operationally you are doing loss that year.
Hmm.
So earlier you were a positive growing company,
Hmm.
or it might have been negative, whatever.
Hmm.
But considering that earlier you were positive or whatever, now you're again declining. It's a declining phase. So that's an indicator for me. If I've invested in already, please take my money out and take an exit, or else not invest. That's a big risk.
Okay, that's fine. What we're going to do with that information is different. But then you would say that negative profitability indicates greater problems as compared to a negative cash flow.
Because that can be received.
No, it's okay. That's fine. I understand. I'm just trying to summarize the point that you made. Right? Anybody else who wants to argue for 2 being more concerned? Sorry, 3 being where the investor has to be more concerned. Okay. Let me hear arguments for 2. Yeah.
So like my operation activity will be my recurring income. So like
No, 1 minute. See, when you talk, see, you have to understand, you have to differentiate between what you're talking about, cash flow or income, because there are 2 different things, right? So you can have operating income and operating cash flow. So let's differentiate between the 2. But yeah, go ahead.
so like my NOPAT being negative might also mean that my taxes are high or like any other reason.
No, 1 minute. See, if taxes are high, but taxes will not turn a negative PBT into, sorry, a positive PBT into a negative PAT, no? Because your taxes are always going to be 30% of or 30% or 40%. So the PAT obviously will be lesser, but then taxes will not turn a positive PBT into a negative PAT, right? So, but okay, but I didn't let you finish. Can you finish your argument?
So like CFO being negative will be more concerning than like CFO like NOPAT being negative because like if my CFO is negative, that means I'm receiving more like less cash from like my daily activities, my more main business activities.
Okay, so basically, a core argument is that look, cash is not coming, so therefore I need to be more concerned, and rather than anything else. Would that be a good summary of your argument? Okay, fine.
I think if CFO is positive, I don't necessarily think that.
No,
there's no cash.
1 second. So, we'll come back to that, right? So let me just hear arguments for 2. Then I will, come back to, what you're saying about 3. Okay. Anybody else who wants to argue that 2 is a situation where there should be greater concern as compared to 3? Yeah.
Yeah, basically, if CFO is being negative, that means my core business's function is not happening properly.
Okay.
And NOPAT is positive. Maybe there's some other non-operational source of.
No, but then we're looking only at no PAT, right? So non-operational will not come at all here. It's only operating profit. So that's the reason I'm not using PAT here. Your argument would have been correct if I had used only profit after tax, but I'm using only operating profit after tax. So non-operating does not come into the picture at all. Okay.
Basically, the CFO second would be more concerning.
Okay, that's because you're saying that cash is more important than the profit that you're making, right? So similar to the point that he made. Okay. Yes.
The same point because second is more concerning because as you said, even if the CFO is negative, you don't know where the profit is coming from.
No, but then it's only operating profit.
Operating profit.
Okay.
In the third one, you shouldn't be that concerning as an investor because if you know CFO is positive, that means the business is doing well. When you're looking at that, it's just like operating profit. As you said, it's only operating profit, so it's not the whole year. So you're going to be less concerned over there because there'll be other expenses like marketing expenses or other operating expenses. So I'd look at more if the business is doing well and if the business is operating well. That's what
From the cash flow point of view. Okay, right. Okay. No, fair. See, again, the answer that I'm going to give you is not something that is, applicable 100% of the time. I was telling somebody during the break, right? So I think I was talking to Ishan. So where I was telling that, look, the way to understand the framework that we use in finance in general is that you are given a particular context, and then you say that look, given this particular context, this is the framework or this is what I would expect. And then you will say, give me more information about that particular company, and then I will tell you, how the actual, situation of the company might deviate from the average that I have in mind. So the discussion that we had in the previous case, where we said that the plus and minus that we had, right? So given that we just know that it is a startup or introduction phase or mature phase or declining phase. So the CFF example that we discussed, right? So if you go back to the previous slide, what we said is that in the case of a declining mature company, the expectation is that the cash flow from financing is going to be negative. But if you come and give me additional information where I say that, look, it's a declining company, but they're hoping for a turnaround and they're actually raising money from investors who would like to take that risk. So typically, like how you have what is called as venture capital. What do you think is opposite of venture capital? It sounds like a ridiculous question, right? If I ask you what is the opposite of venture capital. So there is another VC which is the opposite of the VC that we are used to.
Private equity?
Not private equity. Private equity.
Investment bank.
No.
Wise capital.
No, venture debt is just a complementary of venture capital.
Wise capital.
Angel
No.
investing?
No, angel investing much earlier, before VC. Huh? What are they called? Why am I calling them as VC when I talk about corporate traders, which is not 100% correct, but then I'm looking at a more specific case of VC, another VC. So, okay, another VC is what we call as vulture capital or vulture investors. So, venture capitalists are the ones who invest in young companies. But what do vultures do?
Dying company.
So what vultures do is they actually go and, of course, they also perform a necessary function in the ecology, right? So that way, what vulture capitalists do is vulture capitalists invest in dying companies with the hope that these companies can be turned around, right? So if no, I mean the hope. The question is hope, right? And the stripping of the company that you're talking about is a different thing. So that is where you have LBOs and kind of a thing, right? But then when we talk about vulture capital in general, you are actually talking about companies that are almost in the grave, but whereas you will inject further capital, hoping that you will be able to actually turn around the company, right? Again, huh? Yeah, so when Microsoft bought Nokia, it was sort of a vulture capital kind of investment because they said that, look, this was a good company, and right now it is actually facing these issues. So let's actually. So why would vulture capitalists be interested in buying a company?
Is the legacy of the company that might also hold
Legacy, yes, but then think about. I agree with your point.
Nokia has manufacturing facilities as well.
Correct, but then what is the key reason why they will invest?
Because first they have the valuation at a low price, so they decide.
So you will get at dirt cheap valuations, right? So the point is that the reason why, so see, the reason why venture capitalists invest and why vulture capitalists invest, it is the same reason. So what the venture capitalists, or if you talk about angel investors, so why do angel investors invest, or why do these early venture capitalists invest? They say that, look, I see that there is a great company that is there, but then the entrepreneur does not know that this is going to be the next Meta or the next Google or the next whatever you want to insert there, next HDFC Bank, if you have to take Indian companies, right? But then you will say that, look, I expect that this company is going to become very big, but none of the other investors actually know that, and the entrepreneur himself or herself actually does not know. So let me come in early where I will get a much better valuation as compared to the if everybody gets to know. So if everybody gets to know that a company is good, what will happen to the valuation of the company? Obviously it will increase, right? So you would want to come into the cap table before everybody gets to know that there is a good opportunity that is that is there here, right? So that is the outlook with which the venture capitalists come in, but they know that they are taking a risk, because if they invest in 10 companies, not all of 10 of them are going to be successful, but they're okay with that, right? So they want to make sure that they increase the probability that they are investing in good companies, but at the same time they also know that not all of their bets are going to pay off. So the vulture capitalists also do something similar, where they say that, look, I know that out of the 10 companies in which I invest in, not every company is actually going to be turned around, but then I'm willing to take that risk because, I'm actually going to get valuations which are much lower. And I'll be able to get, what we call as, in the US, it is called as you get dollar for pennies, right? So what it means is that, yeah, so the phrase is pennies on the dollar. So what it means is that you're actually buying $1 worth of fixed assets or assets, but whereas you're paying only 5 pennies for that. So that is what is actually called as getting a dollar for a pennies, or pennies on the dollar, right? So the outlook of both the VC as well as the one VC and the other VC is exactly the same, where you're taking a lot of risk, where you have a lot of information that is not there, but still you want to invest because in the case of startups, you're hoping that this startup will become bigger, and in the case of venture capital, you're hoping that there is actually going to be a turnaround for this company, right? Okay, let me take questions. Yeah, he's been trying to ask.
So, like, what do they do? So they just hope the company will turn around.
No, obviously
They
no.
get
Yeah.
into the office.
Yeah, they do that, right? So typically what they will do is that they will have a team, right? Or they will get somebody to run the company, right? So maybe they will say, okay, we will actually buy the company so that we can control the company. And then you get a CEO where you will tell that, look, if you turn around and if the value of the company increases, then like how we give ESOPs, right? So you will say that, look, I will, give you additional equity in the company, or you'll get a bonus if you're able to kind of increase the sales and increase the profits. No. See, what? Huh?
Buying companies and they sell it.
No. Private equity doesn't do that. Private equity buys mature companies.
Sometimes they buy dying companies. They
See, see, it is.
operations and they sell it in parts.
They can actually do that, right? But then, that is not called as vulture capital. So those are companies which are probably at the stage of dying. But vulture capital is further down the life cycle, where you can obviously see that the company is actually dying. So what private equity does is they actually buy companies that are not doing well. There is a difference between not doing well and dying. So venture capitalists come a lot later as compared to private equity. Okay. Yes. Vulture capital, see again, see any investment that is made in dying company. So, for example, they were trying to do that with Jet Airways, right, where they were trying to sell that off, and they were trying to look for investors where they can actually invest. But then that did not happen. But it happened with SpiceJet, right, where SpiceJet was under so much of losses. And the original founder of SpiceJet, who was, his name is Ajay Singh, I think, right? He came with a consortium of investors where they got SpiceJet for, peanuts, and they were hoping actually for no turnaround. So Indian example is, it was not officially called as vulture capital, but then you can actually see that it was a vulture capital investment.
Jet Airways was the same case, right?
Yeah, I mean, huh?
Jet Airways. SpiceJet occupied all the carriers of Jet Airways.
No, that's different. No, that you're occupying the slots, but then there was no investment in the company. Again, let's take it offline. Okay. So there's a difference. Yes. Sorry, is that clear? What I was trying to say? That's one example. Oh, like that. Okay. So that I'm not aware. But then, there is actually a book called, Vulture Capital or Vulture Investing, I think. Just Google for it. The person who's written the book is he's a famous, vulture capitalist. See, but the problem is nobody wants to be called a vulture capitalist. Then the general impression of is this working? Okay. So the general impression of a venture capitalist is that you're doing good for the society, but then that's not the impression that a vulture capitalist has. So people don't actually tom themselves as vulture capitalists. You just have to know, based on their behavior, you either call them a venture capitalist. But check out this book. It's called Vulture Investing. You'll get some idea about how they actually think about, vulture investing. Yes. That's also possible, right? So again, there is nothing wrong in actually doing that, right? So you will say that if a company has 10 different parts or 5 different parts, and you say that only one can be actually salvaged, you will sell the remaining 4 and then you will salvage only the one. That's also possible. See, there's no legal rule. See, there's no legal definition of vulture capital, right? So it's just a way to describe the outlook of the investors. Okay. All right. Any other questions? Yes.
During the vulture capital investment, is it that like these investments happen more with their complementary goods, complementary industry?
Not necessarily, but let's take it offline. Okay, we'll discuss this. Okay, all right. Let's move on then. Okay, so now just to answer this question here, what you can see here is that the way I would like to kind of think about this is, see, if you have a cash flow problem that happens once in a while, typically when you look at cash flow problems, they indicate temporary problems as compared to the profitability problems that you will have. So if you are not profitable, it is more difficult to make a company profitable. Let's say that you're loss making, it is more difficult to make the company profitable as compared to, let's say, if a company has negative cash flow, it is relatively easier to make that into a positive cash flow company, right? So in that sense, where profitability being negative indicates a much more deeper problem as compared to a negative cash flow from operations. I would say that an investor who has a company which has a three kind of situation where the profitability is negative but the cash flow is positive, I would say that here is where the investor needs to be more concerned on average as compared to the concern that the investor has in box 2, where the profitability is positive, and then you kind of figure out, okay, why is the cash flow negative? It could be because that the company is not able to collect money from trade receivables. So therefore you will say that that's a easier problem to fix as compared to making the pricing of the company profitable. There might be a lot of competition, and therefore that might be the reason the company is unable to charge proper prices so that actually it can become profitable, right? But then if continuously the company is unable to collect money, if continuously the company is having negative cash flow for a number of years, then the problem is definitely serious, right? Because ultimately without cash you can't run the company. Remember that cash is like oxygen that I keep telling. So while it is possible for you to for a human being or for a living organism to stay without oxygen for short periods of time, it is not possible for them to actually be without oxygen or air for long periods of time. So that's the way we we can understand this. Okay, again, if you disagree with that, that is fine. There's no need to agree with what I'm saying, but let's actually discuss this offline, because at least I want to start financial statement analysis today. See, now we actually come to the most important part of the course, right? Because all this while what we've been doing is that we've been laying foundation for what we're actually going to be learning in financial statement analysis. So what we do in financial statement analysis is that once we have understood again, just to do a quick recap, all right? So what we did is we understood the basics of accounting, how it works, and how your real life transactions are actually reflected on the financial statements. And then we spend time on the three financial statements, understanding SPL, balance sheet, and cash flow statement a little bit more deeper, and understanding the, wake him up please, and understanding the, here. So understanding the different items that are there as part of a statement of cash flows. You want to step out for a second? Okay, no, that's not a request. Okay, right. So yeah, just just go wash your face and then take a quick walk and come down. Okay, so now what we are doing is, now that we have understood the financial statements, obviously the most important part to do is to analyze those financial statements for us to understand how has been the performance of the company, right? So then what you have to remember is that your FSA is a tool, and the utility that you get from FSA depends on how you're actually going to use that tool. So the way we use FSA is that we use FSA to identify the red flags that is there for a company, and that's not the end of the story, right? So now I have to investigate those red flags and try to figure out as to what is the reason for those red flags, or what is the explanation that is there for those red flags. So don't treat FSA as an end. So it is actually a means to identify, or it's a beginning to identify the red flags, or it's a way to identify which are the problem areas that the company is facing, and you have to ask further questions or get more data to understand if that problem is actually a problem, or is that problem something that is temporary which can be easily fixed, or is it a problem that is permanent and it requires more effort, or it's a problem that is impossible to solve, right? So that is the kind of follow-up that you need to do after you've done the financial statement analysis. FSA, again, for being short. Obviously, common sense is the best companion. I mean, that's true for anything that you do in management, anything that you do in life, but anything you do in management, especially when anything that you do in finance and accounting. But when I say common sense, I am not talking about general common sense. While that is required, I am also talking about general business common sense as well, right? So you need to be able to kind of understand how businesses typically function, right? And what are the important things that a business has to do. That's something that you need to develop over time, right? So that's something that you need to keep in mind. And always, whenever you look at a number, you always need to kind of think about what this number is actually telling us, right? So what I'm doing is that I'm giving you these broad, points that I want you to keep in mind, and then we will go into the specifics when we actually learn more about the details of financial statement analysis. So the objective FSA, what we do is largely we look at ratios, and most of the things that we do in FSA is what we call as ratio analysis. And the objective of this ratio is, sorry, and the objective of actually doing this ratio analysis is that you don't take any two numbers to be a ratio. Say, for example, if I give you a ratio, because what is if you have to have a ratio, all you need is a numerator and a denominator, right? But then that numerator and denominator should actually be measuring some aspect of business, and any two numbers cannot be called as a ratio as far as the financial statement analysis is concerned, right? So let's say that I tell you that I will calculate a ratio that is total of the asset side of the balance sheet and total of the liability side of the balance sheet. Do you think there is a meaningful ratio that tells me something? If I take the total on one side of the balance sheet and that's as a numerator, and if I take the total on the other side of the balance sheet, it's always going to be one, right? So because you're trying to say that, look, your total on the asset side of the balance sheet obviously is going to be equal to the total on the liability side of the balance sheet. So those two numbers, while they are mathematically a ratio, in a finance sense, they're actually not a ratio. So when you look at any ratios that we're going to learn, maybe we'll start today and then continue tomorrow. So when you look at any ratio that you're learning, there are two things that I want you to kind of think about, right? So one is, when you look at any ratio, one, you have to kind of think about what aspect of the business the ratio is measuring, right? So what business aspect the ratio is measuring. So when I look at, say, profit margin, what business aspect is the ratio measuring? When you look at profit margin, the profit margin that we discussed earlier, what aspect of the business is the profit margin measuring? That is profit divided by revenue? No, that's the definition of the ratio, right? But I'm asking, what aspect of the business the profit margin is measuring? What is it that is telling me about the business? You're looking at profitability, right? So you're trying to say that, look, ultimately companies have to make profit. At the overall level, we are trying to figure out if the company is actually profitable or not. And we are trying to say that, at what level the company is profitable. Is it a low profit margin the company has, or is it, does it have a high profit margin? That's the question that we are asking, right? So first thing. Second thing is, we also need to understand whether a high value of the ratio is good news, or a low value of the ratio is, good news, right? Because, for most of the ratios, you will see that a high value of the ratio is actually good news, low value of the ratio is bad news. So if you're a company, would you like to have high profitability or low profitability? Obviously high profitability, right? So profit margin, you need a high value for the profit margin, and you will consider that as good news. But then there are some ratios which you will study where low value actually indicates that the company is doing better, right? So for example, in cricket, would you want to have more number of runs or less number of runs? More number of runs, obviously, right? So in golf, would you want people are familiar with golf, would you want a positive number as a score or negative number as a score? Because the way the scoring works in golf is that the higher the negative score that you have, it means that you actually perform better. So that's the way you have to understand the ratio analysis as well, which we will of course discuss as we kind of go through the other things. And so the objectives why we do this FSA is, one, we want to kind of evaluate what has been the past performance. We are looking at how the company has performed in the past, and we want to evaluate if the company has actually done well. And more importantly, we want to kind of forecast or predict what is going to be the future performance. So one, an obvious way where the ratio analysis is used, or where financial statement analysis is used, is, let's say that you are a company which is actually asking for a loan. So then you will go and ask the bank for a loan. What do you think the first thing the bank usually asks for? They will ask for financial statements, right? And more specifically, they will ask for audited financial statements, because they want to make sure that somebody has actually looked at these financial statements and they're saying that the financial statements are actually following the rules of accounting and they're representing the true and fair view of the business, right? So when you actually do that, so what the bank will do is, they will look at these audited, past historical financial statements, and there is something else the bank also asks for in terms of financial statements. What is that? Yeah, so that is an income tax return, correct? But then that has to got to do with the past. But I'm saying, with respect to financial statements, they will ask you for past historical audited financial statements. They also ask for something else as well, some other form of financial statements. What is that? No, credit score the bank will find out, but that's nothing to do with financial statements, no? There is another kind of financial statements that the banks ask for when you apply for a loan. That you get it from your historical statements, right? The bank will do the analysis.
The comparative analysis.
The bank will do that because
taking the economic entity concept,
No. Okay. Okay.
banks even ask for the founders.
No,
Details in the
listen to my question, right? I'm asking specifically, as far as the financial statements of the company is concerned, there is another set of financial statements that bank ask.
Maybe future order books or work
Right. So, or in other words, what the bank will ask is they will ask for forecasted financial statements, right? So, what the banks will say is that, look, assume that I'm actually going to give you a loan. Tell me what you're actually going to do with that loan and how your numbers actually will look like, right? So, in order to prepare your forecasted financial statements, you'll use information like this, right? So where you will say that you will look at what is the order book that the company has, or what are the future orders that the company has got, or what are the kind of customers that they have. So you use that information to prepare the forecasted financial statements. But the banks will actually ask, the bank will tell the lender that, look, if I assume that I'm actually giving you a loan, and what is it that you're actually going to plan, do with this loan, right? So typically the banks will ask for something called like a business plan, where they say, what are you going to do with this loan? Companies that actually come for IPO, they also have to disclose that in their prospectus. So in the prospectus they will say, what is it that we're actually going to do with the proceeds of the issue, right? So whatever is the money that we're going to get, what is the plan that the company has to give? Of course they'll give some bakwas there, right? So that is there, but at least there is a legal requirement saying that you have to disclose what is the plan that you're going to have. And in case you don't use that as per whatever you have declared in your prospectus, then you can actually be taken to court, right? Because it's a legal obligation that the company has. So what companies will do is they'll give some generic explanation, where anything that you do can be fit into that explanation that the company gives as to how it's actually going to use the proceeds of the issue. But the banks are stricter. So in the bank, when you take a loan, if you tell the bank that, look, I am taking this loan in order to buy some machinery, and if you go and buy inventory with that money, the bank will actually hold you responsible, where they will say that you had told me that you're actually going to use this money to buy machinery, so you better actually use it for machinery and not for other things that are there, right? Of course, entrepreneurs will try to kind of manipulate the bank, where they will try to show all sorts of accounting jiggery that is done. But that's a different story. I'm just telling you that when you look at financial statement analysis, this is like a very practical and a simple way to use financial statement analysis, where you will say that, look, historically, say for example, typically what entrepreneurs will do is, historically, let's say the company has been making a profit margin of 10 to 15%. In the forecasted statements, they will always say that we will make profit margin of 60%. Okay, so as a banker, my question will be simple, saying that, look, you've given me financial statements for the last 3 years. 3 to 5 years is the normal time that bankers ask for financial statements. So the question will be that, look, you've given me financial statements for 3 years. Now in the forecasted statements, you're and you're telling, in the last 3 years you've made a profit of 15% profit margin. But in your forecasted statements, you're showing that you're going to make a 30% profit margin. They will say, justify how you will be able to actually increase it from 15% to 30%. So if the bank is unable to get a proper answer for that question, will the bank give a loan? Bank obviously will say that they're actually not going to give a loan. Exact same thing is followed by your late stage venture capitalists as well. So in the early stage venture capitalists, right? So typically what is called as a seed round, there are no numbers at all. So then you kind of go with what is the story that the company is selling. You go with what is the potential of the company. But then if you're a late stage VC investor, you'll have some sort of numbers, and then you will ask, okay, show me the numbers and show me what is the kind of expectation that you have for the future. And if I think that I'm going to believe that, or if I get a proper justification that the profit margin will increase by from 15 to 30%, then I will give a higher valuation for the company. Or if that is not the case, then I will revise the financial statements and then say that, look, I will invest in the company, but then I will invest at a lower valuation as compared to the number that is being asked by the entrepreneur, right? So these two examples, where a VC is investing and a bank is deciding on whether to give a loan, is examples of where we use the financial statement analysis, where you evaluate the past performance and then you predict the future performance of the company using the understanding of the financial statements. Does that make sense? Okay, but as an angel investor, will I do all this? By the way, who's an angel investor?
Someone who is investing in a startup at its very early phase.
Right. So typically, there is something called as an idea phase of a startup, right? So imagine that a startup founder has a dream, and then they get an idea in a dream, and then they come and share it with their friends. So angel means somebody who is willing to trust you without any evidence for that, right? So that's the way you have to understand angel investors. So typically, that's the reason your angel investors will typically be friends and family, and people who kind of know you personally, right? So that is how traditionally angel investing has been. But nowadays, I have all these angel investing networks, where these are people who are willing to take that risk, where they are investing in the idea and in the person, and not without they don't they obviously can't get any hard numbers because the company probably is not even registered, or is just probably registered 2 months back, and it's operating probably has not even started. I'll take questions later, right after the. No, it's okay. I'll take questions later, right? Because I want to finish a few things. So the point here is that angel investor obviously will not do this, and an early stage VC will obviously not do this. But then it is still useful for you to kind of understand what are the typical benchmarks that is there in that particular industry. That is where your knowledge of financial statement analysis becomes useful, right? Okay, so let's I want to finish at least a couple of slides, right? So I'll take questions after the class gets over. So if you look at the kind of there are some general points that I want to keep in mind. Can somebody tell me what we mean by caveats? What is the meaning of the word caveat?
Exceptions or
Not exception.
terms and conditions.
Mm, terms and conditions is closer.
There is scope for you to derive something else from that.
Threshold metrics.
No. No. Anybody else? You're on the right lines, Surya, but something like a catch, right? So caveat is something where it's a characteristic where you have to be careful, or So have you heard about this phrase called caveat emptor? Okay, so forget that I mentioned that. It's something to do with legal stuff. If you have, you can actually Google for this and then figure out as to what we mean by caveat emptor. Right, it's Latin, but then that's only Latin I know, right? So only two words that I know. But caveat emptor essentially is something that is used in law. Please Google for it and then figure out. So caveat essentially means that you have to be aware, or you have to beware certain things. And these are the things that I want you to keep in mind when you're actually doing financial statement analysis. See, learning the definitions of ratios and calculating them, that is the easiest part of ratio analysis, right? So you actually don't, anybody with 10% of a brain can actually do that, where you actually learn the ratios and then you calculate what is the exact number that you're going to get. But the more interesting bit and the more important bit is learning to understand what are the kind of errors that might happen in ratio analysis, and the kind of inferences that you have to have from the numbers that you're actually seeing. That's something that I want you to keep in mind, right? So let me actually ask a couple of questions that I normally ask when I start this topic, and then we'll close for today, and then we'll continue this tomorrow when we're meeting tomorrow. Okay, so now let me take the example of two companies, and I don't know if I have done this before in the class, but the deal I have with my daughter is that I have to use this. Oh man, I'm forgetting the names. My daughter is going to kill me for this, right? Right? So you can guess which is a favorite movie of my daughter. So this is from COVID times, right? So when I was doing classes, online classes from from my house, obviously my daughter and son learnt a lot of finance. Right, because they were listening to what I was doing, right? So my son would generally come and throw some finance word. Okay, I'm like, how the hell did he get to know about it? So then he said, I heard you speaking. He doesn't know what it means, but he just just to irritate me, he comes and does that. So my daughter came up and said that, look, you always keep saying company A, company B, right? Why don't you use names? And this is the deal that I have. That all of you know what I'm talking about, right? Yeah. Okay, right. So which movie is this? Frozen. Okay, okay. Most of you know. So if you have, you have not heard the movie. So there are two characters in a movie called Frozen. If you want to punish him, you can punish him later, right? Because I think this is the first person who's telling me that they actually don't know Frozen. Okay. So anyway, so two characters who are there in Frozen. Let's say that there are two companies. Now let's say that I give you the data where I say that the profit after tax of Elsa is 1,000, and the profit after tax of Anna, let me call it Elsa Limited and Anna Limited. Okay, and the profit is 1,000 for Elsa Limited and 10,000 for Anna Limited. Which company is doing better? Why is Anna doing better? The profit after tax is higher, right? It depends on what?
Depends on the stage and objectively.
Objectively fine. So assume that both of them are in the same stage. Both of them are in the same stage and of the life cycle, and the profit after tax is 1,000 for Elsa and 10,000 for Anna. So you would say that Anna is doing better because it has a higher profit. All of you agree with this? See, obviously, if the answer was so easy, I wouldn't have asked the question. Right? What else do we have to think about? You need to look at revenue, right? So they might be in the same stage, but let's say that I tell you that the sale of Elsa is 5,000, and the sales of Anna is say 1 million. Okay, what is the measure that we have to use, or what is the metric that we have to use? We will use profit margin, right? I mean, percentage PAT as a over sale. So we call that as, because we have learned finance now. We are not going to call it as percentage, but we're just going to call it as profit margin, because essentially the same thing, right? So profit margin here, you will see that Elsa's profit margin is 20%, but whereas Anna's profit margin, is it 1%? 1 million is 10 lakhs, right? So it is 1%. So who is doing better now? Elsa is doing better. Why do you say that Elsa is doing better? The margin is higher for Elsa, which is 20%, as compared to Anna, that has only a 1% profit margin. So yeah, why? That's the next point, isn't it? I didn't give you this information, but let's say that I tell you that these are actually not in the same industry, and the average profit margin, what we call as the average, so if I say that the average industry profit margin in the case of Elsa's industry, so right now I had not given you any information about the industry, but now I'm giving you additional information that the average industry profit margin for where Elsa is operating is 40%, and the average industry margin for where Anna is operating is minus 5%. How would your answer change? Why is Anna doing better?
Because their average profit margin from the market is way more high, where the market is burning. They are at least making something.
They are at least making some sort of profit.
Half the margin of the market.
Okay, so what we are doing here is that we are actually benchmarking the company to its competitors or to its industry. So what we are trying to do here is that there are two things that you need to keep in mind, right? So when you look at only absolute numbers, you will actually not get a correct comparison. So the correct thing to do would be that you look at your relative number, what we call as a relative number. So relative number means that where typically you take a ratio. So you say that, look, a profit of 10,000 obviously is better than 1,000. But then the point is that relative to the sales that the company is making, you look at the profit margin ratio and then say that I will look at a relative measure and not an absolute measure. So that's one of the caveats that you need to keep in mind. And the second thing is what we call as benchmarking. So benchmarking means you will say that, look, let me understand the context in which this company is operating. So for example, if I come and tell you that you have a batsman who has a career strike rate of 120. Okay, is that a good strike rate? By the way, people who don't follow cricket, strike rate means that if you face 100 balls, 120 means that how many runs you're scoring, right? So if you face 100 balls, this batsman on average actually scores 120 runs. So it means that if you face 10 balls, you would expect that the batsman to score 12 runs, right? So that is what actually strike rate means. So if I tell you a strike rate of 120, a batsman has a strike rate of 120, and if I ask you whether that's a good strike rate, what would your answer be? It depends on which format you're talking about, right? So if you're talking about tests, is 120 strike rate good? It's extremely good, right? Because you'll not expect batsmen to have a strike rate of probably, I don't know what is Rishabh Pant's strike rate. Probably it will be a little somewhere over there between 100 or between somewhere around 120, right? Okay, one second. Okay, so then what about ODIs? It is good. I wouldn't say it is extremely good. I would say that. Huh?
Yes, the terminology is going over here.
Okay, ODI is what? One day international. Your 50-over match, right? So okay, in my generation, it was more popular to call it as ODI because it's one day international. But now I think you call it as a 50-over match. What, a 50-over match or ODI? I mean, it's. I didn't want it to be again another DLF kind of situation, but essentially 50-over match, right? You will say that it is a good strike rate. You will not call it extraordinary. Would you say it is bad? Obviously, no. What about T20, 120 strike rate? You will say that 120 strike rate is a bad strike rate for T20. So what you're doing there is that you are looking at the context in which this particular strike rate has been scored, and then you're seeing whether it's actually good or bad. So you're benchmarking it to the format of the game. Similarly here, when I benchmark it, what I will do is I'll close in a couple of minutes, or maybe another 5 minutes, sorry. So I will calculate what is called as an industry adjusted profit margin, where I take the difference between these two. So industry adjusted profit margin, I'll write the formula here. So when we talk about an industry adjusted profit margin, you will say what is the profit margin of the company, minus the average, profit margin of the industry. So when I calculate the industry adjusted profit margin for ELSA, the profit margin of the company is 20%, but whereas the average player in the market is scoring, is able to generate 40% profit. So the industry adjusted profit margin is going to be minus 20%. For Anna, what is the industry adjusted profit margin? So it's going to be plus 6%, right? So essentially you're talking about how better the company has done with respect to the average player in the industry. So you will say that Anna's industry adjusted profit margin is plus 6%, but whereas Elsa's industry adjusted profit margin is minus 20%, indicating that what is the performance of the company with respect to the average player in the industry. So it is very important to keep these two things in mind, right? So one is you look at relative measures, and then you do the proper benchmarking considering the context in which the company is actually operating. Now, in the case of the cricket example, the strike rate, the context was given by the format of the game. But in the case of companies, the context is given by the industry in which they are operating and the kind of competitors that they have. Okay, all right. So let me close the class here, but just a quick thing that I wanted to talk about, what I said I want to talk about at the beginning of the class, right? So there have been some instances where, in my office hours, students have actually booked the slot, but they didn't turn up, right? Or there was a case where, I mean, don't look left and right, okay? So because it's like, I didn't do it, who the hell is, done something like that? That's the reaction that he gave. Okay, and there have been instances where, somebody has booked 2 slots, and they have actually come for only 1 slot, and they did not appear for the other slot. Now, I know obviously I know the list of students who have done this, but then I didn't want to kind of call out the names in the class and shame them, because that's not going to help, right? But then I thought I'll give some, just hear out this middle-aged uncle talking about professionalism, for the nth time. That is actually not being professional, right? Because when you actually book a slot and you don't turn up, one is you're disrespecting the other person, that you're actually not, having a professional outlook in terms of not following the norms of professionalism. Also, it is quite possible that somebody else wanted to book a slot and you're actually wasting, right? So you have this, the saying in English, right? Dog in the manger situation, right? So where manger means where there's a hay. So if there is a dog in the where the hay is, what does English proverb say? It says that look, the dog is not going to eat the hay. It is also not allowing cows and buffaloes to actually eat the hay, right? So it becomes that kind of a situation. So what professionalism demands is that if you have taken an appointment, you have to not miss that appointment, and you have to be there on time for that appointment. A couple of minutes, late here and there is fine. But then the point is that you have to make sure that you actually turn up. But sometimes you might have instances where something else comes up, something else that is urgent that comes up. Then you have to make sure that you inform the person that you will actually not turn up. And informing the person should be before the appointed time starts. Typically, I would say at least half an hour before the appointment time is there. So if you have taken an appointment with me at 2 o'clock, make sure that you inform at least by 1:30 that you're actually not going to turn up, because that's what is expected of somebody is actually acting professionally. Okay, so some of you might already know this, but since it has happened 3-4 times, I thought I should actually talk about that in the class. And I have no interest in kind of pointing out and then say that these are the people who actually did this. But it's quite possible that there are others also who might actually end up doing it, because it happened again yesterday. That's the reason I thought I should talk to the class and tell you that what is the expectation that you have, right? Are you with me? Do you think it is reasonable, that somebody should expect that this should happen? Okay, so if you follow this, and sometimes you get late, then trust me, people will be more forgiving as compared to not taking this thing seriously. And you might have a genuine situation where you might not be able to turn up. Then obviously people are not going to be that forgiving when you have this kind of situation, right? Again, this is something that I want to think about. And if you're interested in having a professional behavior, please follow it. If you think that I just wasted 5 minutes of your life, then obviously I have a choice of not following it. But just remember that there are going to be consequences, right? Because there's nothing that I can do, but in the real world, you will have much more consequences that are that probably will hurt you both in the short run as well as in the long run. Okay, all right. So yeah, that's the end of the rant that I had. But yeah, if you have any questions, please come down. I will kind of talk to you. Else, I'll see you guys tomorrow. Okay, thank you and bye.